Let us now look at some examples of methods under different categories. For this, I will share the asset-based approach, income-based or market-based approach, and cash flow-based approach. For asset-based approach, some of the disadvantages of this approach was highlighted by Wilson. To name a few, it does not focus on income the assets could produce, or in other words, it focuses on the asset values but ignores the future income that the assets may bring. It might also miss the value of intangible assets for obvious reason of it being difficult to value. Therefore, for companies that potentially have more intangibles, this approach would be less relevant. And most of all, this approach deviates from the market value or the current value, which some may find as the most relevant. For asset-based valuation, it takes into consideration asset-based values, the book value, the replacement value, the realization value, and the liquidation value. The book value is simply the historical cost minus depreciation, but this value is deemed useless as it does not reflect the current value, thus adjustments might be needed here. The replacement value is looking at the cost of setting up similar business if it were to start at the current time. But this is also impractical as it might miss on the intangibles that have been accumulated throughout the business's lifetime. The realizable value is the value after selling all assets and settling all liabilities. But this is for the worst case scenario, and we definitely expect more if that is not the condition where the company is in. The liquidation value is the value after selling all assets and settling all liabilities, but these were made in a shorter period of time compared to realizable value, and thus larger loss is expected. Out of these four values, realizable value could be the most appropriate for viable company, and we might want to also consider market value or fair value and economic value when doing so. An example of asset-based method include net tangible asset. This is where business value is determined by assessing the book value of its tangible assets and minus from that its liabilities, and added to that the increase or decrease in the fair value of assets and liabilities. From here, we can also determine the share value by dividing the business value with the number of outstanding owner shares that the company has. Income-based approach is quite dynamic as it depends on the operation of the company. For example, consider all these three operations: company that produces cement, company that provide parking lots, and company that provide insurance. When we want to value their income or earnings, what should we look at? Yes, you are correct. For cement companies, we will be looking at their annual production capacity. For companies that provide parking lots, we will be looking at the number of parking spaces, and for companies that provide insurance, we will be looking at the annual premium. Some of these companies might consider cash-based methods, while some can only use cash-based method. Basically, for income-based approach, it will use the projections of future income to estimate the present value, and this is suitable for companies with few assets and financial histories, but with a lot of potential, like online businesses and web designing. Just to put it into perspective, again, I will be using Instagram as an example. In 2012, it was taken over at $1 billion when the revenue was zero. But when it was acquired, it was assessed based on its potential in the future. The owner of Facebook saw that potential where more people were anticipated to use the platform to share pictures and do businesses. And it was proven. In 2014, it grew to $35 billion. And in 2018, the two founders left. And in 2019, it was valued at $100 billion. Let us now look at PE ratio, or price to earnings ratio, or PER. You should be very familiar with this. This ratio gives a value that indicates the ringgit amount or the price investors can expect to invest in order to receive 1 ringgit of the company's earnings. And as identified earlier, it also known as price multiplier, meaning it shows how much investors are willing to pay per 1 ringgit of earnings. For example, if a company is currently trading at a multiple of 20, it means investors are willing to pay 20 ringgit for every 1 ringgit earnings of the company. So if the current earnings of the company is 200 million ringgit, thus investors are willing to pay 4,000 million ringgit or 4 billion ringgit. That is how much they value the company. The PE ratio is the most common tool to value share, but how do we know if the share price is overvalued or undervalued? We need to compare that to the industry group or benchmark. We may refer to those in S&P 500 ratings, Moody's rating, Fitch rating, or for Malaysia, RAM and MARC ratings. A high PE ratio could mean that a share price is high relative to earnings, but it can also be overvalued. Regardless, this also indicates that investors are expecting higher growth in the future, and a lower PE ratio can mean vice versa. We can calculate the PE ratio using this formula, current market value per share divided by its earnings per share. Now let us look at the example of Walmart. In November 14, 2017, the share price closed at $91.09. The EPS was $4.40. So Walmart's PE ratio was at 20.7 times. Since the current average market at that time was 20 to 25 times, Walmart's PE ratio is within the average market range. Let us look at this example. We have 4 companies here: Fly Berhad, B Sdn Berhad, Great Fly, and Big Fly. Fly Berhad is trying to make a bid on B Sdn Berhad, an unquoted company. Thus it needs to do valuation for B Sdn Berhad. Information given is on B Sdn Berhad's earnings over the past 5 years, the industry PE ratio of 10, the PE ratio of similar but quoted companies, Great Fly and Big Fly. The question is, what would you recommend being the suitable range of valuations for the shares of B Sdn Berhad? Pause this video and take a moment to think about this. Looking at its earnings, the average earnings for the past 5 years is at 67,200 ringgit, while the average earnings for the past 4 years is at 71,500 ringgit. Therefore, there is a prospect in terms of growth, though the future earnings are uncertain. For estimated earnings after 2010, it could be high at 75,000 and above by looking at the growth prospect and the last known earnings in 2010. It could also be lower at 71,500, the average of the past 4 years. We exclude earnings in 2006 since it is way out of the range of earnings in the last 4 years. By looking at the PE ratio, we need to compare that with similar companies. In this case, we are given 2, Great Fly and Big Fly. As for Great Fly, it has growth prospect, and so is B Sdn Berhad, but 15 is just too high, much higher than the industry average, and B Sdn Berhad is an unquoted company. Big Fly, on the other hand, has a poor performance, which is not like B Sdn Berhad, and it has a lower PE ratio of 7, much lower than the industry average. So we can say that the best benchmark would be the industry average of 10. And since B is unquoted, it should be lower, thus perhaps, if you want to talk range, it could be between 5 to 8. So for the valuations of B Sdn Berhad, the high point will be 8 PE ratio times 75,000 ringgit, thus the value of 600,000. the low point will be 5 PE ratio times 71,500 ringgit, thus a value of 375,500 ringgit. Therefore, the value of B's neighborhood would be between the lower 375,500 ringgit and the higher 600,000 or within that range. Now, you may agree or disagree with these values and may suggest a different range based on your judgment. Another method is earnings yield, which is the inverse of PE ratio. The formula is simply the opposite of that of PE ratio, thus EPS divided by share price and then times 100. It will give us a percentage return of each ringgit invested in the share that was earned by the company. This could be used to determine the optimal assets allocation. This method is useful when we are concerned about the rate of return on an investment, thus the percentage. Also, when the company has a zero or negative earnings, earnings yield can still give a value. For example, share A is trading at 10 ringgit with EPS of 50 cent. Therefore, its PE ratio will be 20. That means investors are willing to pay 20 times to get 1 ringgit earnings of the company. And it has an earnings yield of 5%. Share B is trading at 20 ringgit with EPS of 2 ringgit. Thus, its PE ratio is 10. Which means investors are willing to pay only 10 times to get 1 ringgit of the company's earnings. But it has an earnings yield of 10%. Earnings yield can also be determined by dividing net income with its market capitalization. Thus, the market capitalization or the market value of a publicly traded company's outstanding shares can be determined by dividing net income with earnings yield. For example, Apple earnings was 48.4 billion US dollars at one point with an earnings yield of 5.4%. Therefore, its market capitalization is equivalent to 896 billion US dollars. Also, its per share value can be determined by dividing its market capitalization by the number of its outstanding shares. Looking back at the previous example of share A and share B, with additional information on the company's earnings of 200 million ringgit and 10 billion ringgit respectively, we can calculate the market capitalizations for both companies. For company A, 4 billion ringgit, and market capitalizations for company B is at 100 billion ringgit. For cash flow based approach, it values a company based on the company's future cash flows. Thus, it is suitable only if the long-term forecasts of the company are available. For cash flow based methods, DCF is most used of all. Basically, it determines the value of a company based on the present value of the company's future income. However, it does not assume terminations or liquidation, and it uses the discount rate that represents risk specific to investing in the company. For example, if we are using free cash flow or the operating cash flow, we use the weighted average cost of capital or WACC. If we are using equity cash flow, where the value of FCF minus interest and principal of debt plus the new debt, then we use the required return to equity. If we use debt cash flow, where it is equivalent to the total amount of interest plus the principal repayment, we use required return to debt. The good thing about DCF is that it is looking into the future performance rather than the past, where its risk is reflected in the discount rate. However, to get a reliable expected cash flow is not easy, and it is highly dependent upon assumptions and perceptions of future performance. Let us look at this example. In this example, Diverse Berhad, henceforth DB, is trying to bid for Narrow Sendian Berhad, henceforth NSB, where the latter makes 40,000 ringgit a year worth of after-tax profits. DB believes that if money is spent on additional investments now, the after-tax cash flows for 5 years could be as shown. The after-tax cost of capital is 15% and the payback period is expected to be 5 years. The question is, what would be the maximum price that DB should be willing to pay for the shares of NSB? Give it a thought. I'm sure that at this point you already know how to project the discounted cash flow. This is a table that shows the cash flows projection for the next 5 years after the investment made. The present value from the 5 years projection is total at 101,910 ringgit. Therefore, this should be the maximum price that DB should be willing to bid or pay for NSB's share. Another cash flow-based method is dividend growth or dividend valuation. This method suggests that the market value of share is supported by the present value of future dividends. That is, the more dividends anticipated in the future, the higher the market will value the shares of that company. Thus, the formula given, where P0 is the market value excluding any dividend currently payable, G is the growth rate in earnings and dividend, D1 is the expected dividends in 1 year's time, and KE is the shareholders' required rate of return or the required return to equity. To illustrate, let us look at this case. In this illustration, the company paid dividends of 250,000 ringgit this year, while the rate of return of similar company is determined to be at 12%, with additional risk premium of 2%, since Target is a small and unquoted company. You are required to compute the expected valuations of Target if A. The current level of dividends is expected to continue into the foreseeable future, or B. The dividend is expected to grow at a rate of 4% into the foreseeable future. For this illustration, we have the required rate of return to be 14%, with additional 2% representing additional risk. We also have a D0 of 250,000 ringgit and a growth rate of 4%. This represents the dividends in 1 year time, or D1. For A, with no expected growth in dividend, the market value of Target is determined to be 1,785,714 ringgit, while for B, with expected growth of 4%, the market value of Target is determined to be 2,600,000 ringgit. So these will be the values of the company with and without dividend growth. Per share value of Target for situation in A and B can be determined by dividing the value by the number of outstanding shares. Let me ask you again, which method should we use? The answer is no one specific method. The fact is, we have diverse methods to be used in valuing a business, where some methods suit certain industry and buyers. Therefore, the best is to use hybrid so that we can give an accurate assessment of the value of a business. This is just an example of valuation result summarized by Deloitte. As you can see, it used 3 different valuation methods with a value given in range instead of an absolute figure. The chart, which is also known as the football field chart, compares the company's DCF with other benchmarks. To close this discussion, here are some valuation standards that should be referred to should you be interested in valuation. And for Malaysia, we have our own Malaysian valuation standards. You may refer to LPPEH website or Lembaga Penilai Pentaksir Ejen Hartanah dan Pengurus Harta, or the board of valuers, appraisers, estate agents, and property managers. Now that we already know how to do business valuation for a purpose like expansion and sales or liquidation of company, in our final part of insolvency and restructuring, we will focus on capital reduction and receivership and liquidation. Until then, thank you for your attention and I see you in the next video. Wassalamualaikum warahmatullahi wabarakatuh.